Good morning, everybody, and welcome to today's online event hosted by DeA Capital Real Estate. My name is Wolfgang Speckhahn, and I'm managing partner of DeA Capital Real Estate Germany. And I'm very happy to have you with us today and going to our first webinar, which is on real estate investments. The title of today's event is REITs, the easiest and fastest way to invest in real estate. Over the next 2 hours, our lineup of speakers will be presenting you with their thoughts and insights into the current opportunities of real estate investments in REITs for both domestic and international investors. Our distinguished panel of experts will be discussing REITs as an exciting component of investment portfolios, particularly in comparison to indirect real estate funds and listed funds such as Swiss ones. You see here our today's agenda, which will be presented by real estate professionals out of the European landscape, and especially dealing with REITs in particular. During the event, we will be taking questions from the audience. So if you would like to ask a question, we ask for your understanding that we will not be able to do that during the presentation of each speaker. Rather, we like to collect those questions and answer them afterwards. And you will be asked to use the questions and answers function below on your screen, and we will then try to answer as many questions as possible. Coming to our first speaker of today, it's Franca Pileri, Portfolio Manager Multi-Assets from Questio Capital, who is giving to provide us with a macroeconomic outlook, looking at the market's reaction to the global economic situation and what to expect over the remainder of the year. Franca.
Thank you, Mr. Speckhahn, and thank you all for joining today. The most popular statement we heard in the last weeks is that we are in a challenging financial environment. And unfortunately, this is true due to the huge uncertainty related to different factors. Higher inflation with associated reaction of the central banks, and finally a real war in Europe that for sure will have an impact on growth, currently not easy to be estimates. Last week, the IMF reported the latest global growth estimates, highlighting its expectation for a significant slowdown in 2022 due to the conflict. Now, the first revision was 0.8 lower than the previous one, but as we know, the conflict is not over yet, and I suspect that this forecast will be revised down again. Now, history was the symptoms of the broadest of trends. In the first slide, we will try to understand one of these possible trends. Just a little premise to have a better understanding of the context. What we have seen today is that Western world has decided to fight this war not with arms but with capital. In fact, the reaction to the Ukraine invasion was sanctioned to Russia, not only related to commercial trade, but also blocking the payment system and freezing of Russian reserves. What does the freezing of reserves means? Even today, despite the effort to de-dollarize by Russia, we can see in this slide that over 60% of Russian reserves are held in Western countries that have adopted sanctions. And also gold reserves are difficult to liquidate, because they would have to be sold on dollar-denominated markets by intermediaries, which are subject to restrictions. The sanctions have therefore made these resources practically unusable, with the exception for the resources held in China, roughly 14%. The problem is that if an instrument of store of value loses its function in time of need, it's not really a store of value. A possible trend that I would like to underline in this slide is that the freezing of reserves constitutes a precedent that could have repercussion on US dollar as an international currencies in favor of other currencies such as Chinese. In the next slide, we are observing more and more the definition of multipolar world, not only related to geopolitics, but also and in particular to macroeconomic variables. The conflict has amplified the difference among the three poles, Europe, the United States, and China. The first two countries must tackle with high inflation, but in a very different landscape. A supportive scenario for US, both for growth and job market, while that made the Fed more confident to be more hawkish to tackle inflation, and a completely different situation in Europe. In fact, in Europe, the situation is becoming more complicated due to the conflict and the increasing tension with Russia. That could have a very negative impact on growth, with the ECB that could have very few instruments to tackle inflation, without depressing growth, of course. Finally, China. China is a totally different world with higher growth if we compare with the previous two countries, low inflation, and a central bank willing to stimulate its economy after the real estate crisis and the recent new lockdown due to the spread of the COVID. For Europe, in the near term, the scenario seems very gloomy. But if we think beyond the near term, the short term, the conflict will have meaningful consequence for European policy direction in the longer term. For example, more cohesion, common defense, more flexible fiscal rules, and more expansionary fiscal policy, with higher spending on defense and sustainable energies. That in turn further the risk of persistently low growth beyond the near term. So the main takeaway from this slide is that multipolar world gives us ample investment opportunity and portfolio diversification. Now we move on to the next slide, and a key question for investor will be the impact on inflation and thus on monetary policy on global growth as the Federal Reserve maintains its hawkish stance. Of course, there is no magic formula to predict the future growth, but because we have to consider different factors, but we can see in this slide that recession was preceded by two factors: tightening of monetary policy and high oil price. So if the Fed is really going to do 9 rate hikes, as the market think, and oil going up, then growth will be very negatively impacted, and the recession is not so unlikely. At this point, we might ask, what is the maximum rate level that the economy can bear without running into recession? To answer this question, we need to resort to the economic theory and model. One of the models elaborated by Fed scholars, the DeA model, we use this model to estimate the natural rate. Natural rate is an equilibrium rate that does not create pressure neither on growth nor on employment. And this rate is currently 2.25%. The chart shows that every time the Fed broke this rate to the upside, we went into recession. Therefore, unless there is a policy mistake, we can tell that there is room to increase rate, but it is limited in amount. Now, just a quick look to the sentiment indicators. There are a lot of indicators that show us the market sentiments. These indicators are used by investors to gauge the overall mood of market. It's interesting to know that all these indicators show a very negative market feelings. It's also true that often a very low readings indicates that price will likely rise because there are few people left to keep pushing price lower. But even if there is a turning point, it's better to be more cautious due to the initial reason for uncertainty persist. Now, just to conclude, it's always very difficult to predict the future, as I told at the beginning, but in this moment, it's more and more complicated because there are too many variables playing this game: political, economic, and financial. First, we don't know when the conflict is going to finish and the real impact on growth, and also the new geopolitical setup. We don't know either how much the Fed will be hawkish and the Bank of China will be dovish. We learned only during the official communication. Now we are only estimating some potential outcomes. All this to say that we are living a period of high uncertainty. This high uncertainty surrounding the months to follow push us towards extreme prudence in investments, leaving space for potential upside using convex strategies. Natural hedge in this market environment are investment in real assets, which are more resilient to lose value in a scenario of high inflation and low growth. Finally, given the growing importance of renminbi on the international landscape and its behavior its defensive behavior in phases of high market volatility, in my point of view, it can be completely assimilated to a safe haven currencies such as gold or Swiss franc. Now, I really hope I was on schedule and I leave room for questions if there are any. Thank you.
Thank you very much, Franca. Very, very interesting. Indeed, we received some questions, and I'd like to hand them to you. The first one was really coming back to your point on China's role. Do you think it's possible that China decides to give substantial aid to Russia in the current conflict?
Okay, thank you. Also in this case, just a premise to have a better understanding of economic interest of China. The sanction on Russia have not only cut off its access to US, European export and financial system, but have also limited its ability to buy many crucial parts and components such as semiconductors. Major Asian technology suppliers, including Japan, South Korea, and Singapore, have joined the US in banning some export to Russia. So if similar sanctions were even applied to China, whether for supporting Russia or attacking Taiwan, for example, they would be devastating for China's ability to remain a manufacturing superpower. China is doing its best not suffer collateral damage from the Western sanction against Russia. This is the reason, I guess, that now is not convenient for China gives substantial aid to Russia.
That raises another question which has come up in that on that situation. Should we then worry about more war or high inflation?
Okay, good question. They are two different risks. The world has an unpredictable ending. It could be end in 10 days or more likely leading to a prolonged and extended conflict. High inflation over a long period implies a major change in the asset allocation. But I take this opportunity to underline how many things have happened in a very short time, from pandemic to conflict, from temporary to persistent inflation. The speed of these changes lead us to rule out that with the same speed, the things could change again. Hence, the high uncertainty of the period we are experiencing and the extreme importance of the hedging strategies.
Thank you for that positive outlook, I would say, or optimistic one. Can change very quickly again. So let's hope for that. Thank you very much, Franca.
Thank you.
For your presentation.
Thank you.
So we then move forward to welcome Martina Muehlhofer, Head of Capital Advisors and Capital Markets from CBRE, providing us hopefully a long enough outlook for REITs in the capital market. Martina.
Thanks a lot, Wolfgang. I will make it very brief to stay in the scheduled time. We will talk today about European commercial real estate volumes and capital flows in and out of Europe from a real estate perspective. So 2021 was an incredible year for the real estate market across EMEA, surpassing 2019 levels with record transaction volumes. Commercial real estate investment volumes reached a total of 368 billion, which means a 29% increase versus 2020 and marking a new record high from a liquidity point of view. Germany, Sweden, and Norway reached never before seen record numbers in this year. So it was a tremendous year, boosted by large portfolio sales and strong M&A activity in almost every market. We saw large residential deals in the listed sector, like Vonovia taking over Deutsche Wohnen in Germany, but also multiple other big platform deals across Europe, such as the acquisition of Akelios by Heimstaden. In terms of asset class, the office market remains the largest sector in Europe, and it's showing a renewed investment growth by 18% versus the year before. However, office is challenged now by the residential sector, with only 4 billion remaining difference and a strong second position. Just as a reference, multifamily back in 2003 was only 3% of the total market. At the moment, it's hitting 30% of the market, so almost 1/3. For 2022, we are expecting a continued recovery of the office market and further strong inflows in residential. Industrial and logistics have also continued to perform really strong. In 2021, 50% up versus 2020. The hotel sector has shown good recovery, 73% up versus 2021. However, coming from a very low level of 10 billion of volume in 2020. Retail remains under pressure and down 9% versus the year before. So, as a result of large amounts of capital chasing property, we have seen the before-mentioned surge in M&A and large portfolio transactions. In terms of sources of capital, 2021 was driven by domestic capital, but 2022 should get more international again as it was before. So how are the capital flows in and out of Europe? Total capital inflow in Europe has increased by around 20% in 2021. The majority of the capital inflow in Europe is coming from the North American region, representing around 70% of the foreign capital entering Europe. This is a continued trend over the last years. Capital outflows from Europe decreased by 11% in 2021, strengthening the trend of European investors investing in the region. And again, the main outflow target here is also into North America. So North America has always been and remains a strong capital allocator into Europe, while some other regions are decreasing their allocation into Europe. As you can see on this slide, there has been a strong decrease in European allocation by investors of the APAC region, starting from 2022 until today. The Middle East region also started to decrease its allocation in Europe between 2020 and 2021. South American and African investors have always represented the smallest shares of European capital inflows over the last 6 years. In terms of sectors, the office sector showed the highest interest in 2021, both from domestic and foreign investors, being the first asset class by investment volume, as mentioned before. London remains the most attractive city for foreign capital, followed by Amsterdam and Paris, even if pre-COVID levels were much higher and still need to be reached again. On the other hand, the appetite for European logistics is very strong and has grown steadily over the last 10 years. Most attractive countries for logistics investment have been UK and France, followed by Germany, being already a quite mature market for this asset class. So I hope this explanation of the European commercial real estate market in a brief nutshell has been interesting for you. And now I'm going to pass back to Wolfgang for any Q&As. Thank you.
Thank you very much, Martina. That was really a quick overview. I know in the interest of time, but there was one question I think we may want to hand to you. I think from the charts you've presented, it's not clear what is the percentage of capital flowing to REITs versus non-listed funds, especially since the non-listed fund sector has increased in the past and it seems the listed has decreased. But what would be your assumptions in terms of what role play REIT investments for investors?
Yeah, thanks, Wolfgang. I think that's actually a very good question. I think there is some uncertainty in the numbers presented since we do not really have the exact allocation for REITs as part of the listed sector. However, I would say it seems to confirm that real estate investors favor non-listed funds over REITs investments. One might assume that the benefits of the REITs in such a competitive situation, I would say in terms of diversification and liquidity, as well, probably from time to market perspective, seems not to be fully recognized in the market. Therefore, I would say such a conference like you have organized here is really very useful to increase and understand better the asset class and the way it is.
Thank you very much, Martina, for your words. We take that as a positive sign and hope finally that the audience has appreciated the information on REITs and the benefits and opportunities which are in this asset classes. Likewise, thank you very much, Martina. I'd like to introduce to you our next speaker, which is Paolo Scordino, Head of Market and Business Development at DeA Capital Real Estate SGR. And he's going to give us a little bit of background and puts, the activities of the DeA Capital Group into context. Paolo?
Here we are. Ciao, Wolfgang. Thanks for asking me to be here with you today. And let me just enter in my presentation. Again, good morning, everybody. My name is Paolo Scordino. Currently, I am the head of the market development in DeA Capital Real Estate. Today, I would quickly go through the present and future strategy of DeA Capital in Europe, and I will start just for presenting the company in a glance. First of all, DeA Capital has an investor base and products that is done by 54 funds. We manage also one CCAF, and we have an advisory agreement for an Italian REIT. We run all these things for more than 100 of institutional investors, and within these 54 funds, 2 are listed. Just during the 2021, despite the pandemic period, we have done acquisition and contribution for more than 1.3 billion. We have combined asset under management over 12 billion. Our jurisdiction, and we will see further in detail, is Italy, France, Iberia, Germany, and Poland. We manage more than 750 properties, and we do it through our 160 employees across Europe. Our strategy is a wide strategy. We manage several accounts, joint ventures. We do club deals and coming gilded funds. And we provide the full service along the value chain of the real estate. As I've said, the local presence of DeA Capital is today well spread in all the core European markets. We, as SGR, the Italian SGR, we are on the market since 2011, we established the French and Iberia branches in 2019, and we also launched during the pandemic period the branch in Poland, and the new one is the German platform also in 2020. Here you can see the top management of the company. It's important to say that all the European branches are under the head of DeA Capital, that is the holding company that is listed in the Milan in the Italian stock exchange. In terms of the local presence, the main achievements of the last years is that in Italy we are running around 12 billion of asset under management. We are the first real estate fund manager in Italy, independent, and we have set it up 5 funds just last year. France has done a great job in this period because they have done 8 acquisitions of offices mixed use for more than 350 million. And also in Iberia, we have done 5 acquisitions for institutional investors for more than 75 million. 2 of these assets are on the hospitality sectors and 3 are land plots. It is also important to say that DeA Capital Iberia has done a joint venture with an important institutional investors for developing logistic in Iberia. Poland has 4 people in charge of managing the branch. They are not invested directly in the real estate, but they are a strategic part of building up the platform. Finally, the Germany part is important to say that it's the newest, but they already started with these 2 important business lines in which we strongly believe. I don't want to take the floor to Wolfgang and his colleagues, and so I leave to them for more details on these 2 products. Just a quick overview on the industry and the market. That for this presentation I have enlarged not only on the real estate but on the alternative asset classes, because I think that it's important to see which is the trend for the alternatives. I have to say that also for me was really very interesting to see the fact that also despite the pandemic, there was a big increase in between the year 2020 and the year 2021, because there was an increase that was more than close to 30%. And it's important to see that in the next 4 years is expected to have an increase that will bring the numbers to the actual 13 trillion worldwide till to 23 trillion in 2026. This is the expectation. And on the right part of the slide, you can see the split between private equity, private debt, hedge funds, real estate, and others. You can see that also real estate, it's expected to have an important growth of about 72%. Another path that it's important to see and let me say have in mind is also what's going on in terms of M&A and concentration. It's important because you can see that we have a strong polarization. We have faced a strong polarization on the market in the last years, and it's important to see that the first 10 players is running more than 1 trillion of the 1.3, and the AUM share of the top 10 fund managers in Europe is around 40%, and so this means that the big player will become always bigger, and there will be difficulties for the smaller players to gain share of the market. It's also important to see that today DeA Capital real estate has an interesting position, because we are the 28th player in Europe in terms of asset under management. The global capital raising activities goes in the same path, in the sense that was raised around 156 billion in real estate in 2021, with an increase year-on-year basis of about 12%. And again, this is quite interesting, having in mind what has occurred both in terms of pandemic and in terms of political and economic environment. The other thing that it's in line what we have just mentioned before is the average fund size that will is becoming bigger and bigger. Today the fund size is around 558 million, and the new fund closed at 257, and it's interesting to see that compared to the last just 5 years ago, there was half of this. The number is 50%, in the sense that before was done the double of the funds with an average fund size that was really very smaller than the one that we are facing today. Just a look on what's going on around Europe. It's interesting to see how the place where we are focusing has a very active investment activities in the last year. You can see that Germany is the number one in terms of total volume investments. France is the third place. Poland, Italy, and Spain respectively 5th, 6th, and 7th place in Europe. The investment side of in Europe was around 360 billion, again with a strong increase compared to the year before, because it's 25% increase. And it's also important to see that it's true that there are a higher focus on specific asset classes like logistic, hospitality, healthcare, but it's really very interesting to see how also the office investment volumes still lead the sector, because we have faced 111 billion of investments in the offices, and all the investors think that this trend and this path will be the same also in the next few years. Of course, it's important to say that all the new investments has a real great focus on the ESG policies, sustainability, and so forth. I have to say that DeA Capital is very keen to be in this let me say environmental process in terms of investments. We are part of PRI since 2018, and we adhered on the United Nations principles. Just to finish and leave the floor to the question, just a roadmap to success in the European landscape for DeA Capital. First, we are moving on 4 key pillars of development. The first one is the sponsorship of DeA Capital. Again, we really think that we have an outstanding reputation, and we are one of the few real independent player on the market. We have an international background and extensive track record, and it's also important to say that DeA Capital usually has to co-invest because we think that the skin in the game and have the interest aligned with the investors is always the best way to show how we believe in the strategies that we are proposing. We are a fully integrated platform in Europe. We are the only one that has presence in all in these countries, and in these countries it's important to say that DeA Capital is not an asset manager allocator, but it's an asset manager to core, in the sense that we run the full range of activities in each single country, and we do not allocate money for our investors. We have successful investment strategy, and I will show you in a glance. And again, we apply the ESG principle every day in our activities. Just some examples of the ongoing projects. We have launched the Pan-European ESG Build-to-Core funds. We really believe that the Build-to-Core strategy it's an attractive strategy for institutional investors. We are focused on main continental European cities, and the destination of use of this fund is mainly office and residually hotel and retail. The Eurostat fund is always a pan-European fund that is focused on the value-added strategy, because we have seen that some of our investors are asking with a higher risk and return profile, and so we have launched this strategy. Together with EcoGP and some limited partners. As was said before, we are managing a REIT, an Italian REIT, externally managed an Italian REIT. We have launched a fund that is called Dolce Vita on the senior living, and then we have the last 2 funds that is the one for which Wolfgang will give give you more details. That is the Urban Mile Funds and the REITs Fund, the Luxco Real REITs Fund. I had also a slide on the global macroeconomic scenario, but Franca already mentioned most of the things that we have. I would like to show to you, and so I will skip this presentation, and I leave the floor for questions if there is some question that you would like to present to me.
Thank you very much, Paolo, for the insights into the group's strategy. Maybe coming back, that was one question which I have received from the audience with regard to the success factors, and you mentioned the REITs Fund, DeA Global REITs Fund. What is the role in terms of the group's perspective of the REIT team in Germany for the wider group activities?
Thanks for the question that give me the chance to better explain how we work. For us, the German REIT team is a crucial and strategic team, because for us is the competence, really the competence center within DeA Capital Group for listed real estate strategy, like the DeA Capital Global REIT Fund. As we have mentioned before, we strongly believe in the specific of each single branch, and on this the German team will help us in choosing the right investments for this fund.
Okay, thank you. So having this competence on board, another question goes to the back and is asking, what's the experience within the group with REITs as an asset class before?
Maybe you can recall one of our slides. I have mentioned that we are doing advisory for an Italian real estate SIC, and now we are asked to do an externally managed activity for them. And so it means that we have a strong competence on that, and we really believe that the listed fund, as you know, wasn't very successful in Italy. Nevertheless, our two funds went very well, despite the rules that didn't help. But we think that the REITs is really the way to achieve the retail investors, and so we really think that it's important to be in that kind of specific asset, in that specific kind of product, even if the asset classes, of course, it's always real estate asset class, all the real estate asset classes.
Thank you very much, Paolo. I take from it strong track record and deep competence in the field of these asset class of REITs. Thank you very much, Paolo. I'd like to come to our next speaker and introduce you to Serkan Erol. He is European Investor Outreach Manager at the European Public Real Estate Association. And he will provide us with an overview of the global REIT market now, coming more to the edge, so to say. So especially talking about size of the market, diversification opportunities, correlations with regard especially to direct real estate, and the role of REITs in times of inflation. Serkan, it's your floor.
Thank you, Wolfgang. It's a pleasure to be here today to speak at this webinar. So I have a couple slides to run through, so I'll just jump right into it. So listed real estate is an efficient way of investing in real estate. And when I say efficient, I mean efficient in terms of cost, but also in terms of diversification through sectors and through geographies. All the while being highly liquid. So when we speak to investors, institutional investors, the larger ones, what we notice is they invest in listed real estate through a concept called portfolio completion. So in areas where it's much harder to set up a platform, potentially on the direct side, such as in logistics or healthcare or self-storage, they will look to invest in listed real estate through those sectors. And another way that we also see institutional investors investing in listed real estate is through geographic diversification. So potentially a pension fund or an insurance company in Europe may look to invest in Asia or in the US for geographic diversification purposes. So listed real estate, there's sometimes a notion that listed real estate may not be a big market, but when we look through the ICB codes of what real estate is, it's actually a very big market at 3.5 trillion euros. So here is a little bit of information on that, and you can see that there's a split between REITs and non-REITs. So not all countries have REIT regimes, and in Europe, for example, you see that the split there in lighter yellow non-REITs versus dark yellow in REITs. Our policy teams in Europe are working very closely with local governments and economic bodies to establish or improve existing REIT regimes. So when we drill down to our index series that we partner with FTSE Russell and with REIT, which is our sister association in the US, we have about 1.9 trillion euros of free float market cap, which means that there's about 1.6 trillion euros that doesn't actually come into the index. We have certain ground rules, and these ground rules essentially ensure that institutional investors that invest, that benchmark the FTSE EPRA REIT index series know that these companies are highly liquid and income generating. And here is just a little bit of a breakdown as per regions, which I'll go into a little bit more in the next slide. But another thing to note that if, as an investor, you would like to benchmark a fund against very specific criteria, such as logistic European companies, which have been performing very well, that's possible to do. And that would be done through FTSE Russell, our index provider. So globally, you see on the left, so FTSE Russell classifies certain countries as developed and certain countries as emerging. It's not so much an economic position of the country. It is more how regulated the exchanges where these countries have most of their assets are. So on the left, you have the composition of the developed countries, the sector splits, and on the right, you have the emerging. So one thing to note is that the developed countries have a pretty large chunk in 1.7 trillion of euros versus 139 billion of emerging. Another thing to note, and just to, if you see the pie chart, so it starts at offices at 10%, and on the right, on the legend, it goes to the right. So retail being 13%, residential being a sector that has increased massively, as well as industrial. As of late, residential 18%, industrial at 15%, healthcare, which is especially a strong sector in Europe with an aging population at 7%, and so on and so forth. But one thing I think to note on the developed side is you see a very good diversification of sectors. On the right side, on the emerging markets, offices make the large majority of the sector, as well as residential. So this slide, we go through the sector evolution, and here we see how sectors have evolved since December 2006. We see that, so here it's just to mention briefly, so the legend is the opposite. So it starts at the bottom right and diversified, goes to data center, specialty, and so on and so forth. I think one thing to note here is that the diversified sector is actually shrinking. Now, a lot of investors, such as DeA Capital, will actually want to do the diversification themselves. Some investors obviously do like large diversified companies, but what we're seeing is some of the sectors are growing, and the diversification one is shrinking a little bit. Looking at the individual sectors, residential, as I've mentioned, has been growing quite significantly. Data centers, which is a new kind of hot sector in listed real estate, and specialty being cell towers and timber, have grown quite significantly as of the last, let's say, 3 years. They're relatively new sectors and sectors that are attracting a lot of attention. And then we have healthcare, which is a sector on the listed side that's performing quite well. And residential retail is a little bit of a split between US and, let's say, Europe, in that US retail companies since the pandemic have actually performed quite well. Whereas in Europe, a lot of the large retail companies are going through management changes, strategic changes. So there's a little bit more of, let's say, change going on in that sector. When we look at the total returns by sector on a global level, I will briefly just run through what we're seeing. Self-storage has really been the hot sector over the last year, and this is across all regions, I would say. In Europe, we have 3 strong self-storage companies within the index. Industrial is a sector that a lot of you will have heard about, that's performing extremely well once again across the globe, and by all research that we read, it looks like it still has some room to run. The residential landscape in Europe over the last year has been a little bit more challenged, let's say, than the US, in that a lot of the residential companies in Europe are predominantly based in Germany. And there's some, let's say, political challenges, and but as a lot of the residential companies in Europe say, it is not anything really to do with rent caps. It's a supply issue, and that's really where the government should be focusing their attention. On the retail end, as I said, a little bit of a difference between US and in Europe, but we're confident that retail real estate companies will adapt. They have to, and sooner or later that sector will start doing quite well again. Healthcare sector has performed quite well. There's been a little bit some challenges, obviously, with the pandemic, with how some of the nursing homes and care homes have been impacted. But over the long run, healthcare still looks like a very healthy sector. Specialty and data centers I'll include sort of together, in that they are very new sectors. They're attracting a lot of attention, and a lot of investors are looking at these sectors. For example, the concept of portfolio completion. Offices is one that was a little bit challenged, let's say, through the pandemic, but there's a flight to quality concept. So offices that have good ESG credentials, that are modern in good locations, will still attract very, very good tenants, such as tech companies or investment banks. And then lodging and resorts are a cyclical sector. People still want to travel for holiday purposes, so we see some healthy demand there. On the business travel side, there might be a little bit more restriction, but also a sector that we look to perform well soon. Going into diversification. So we did a study with CM Benchmarking, which is a Canadian company that looks at pension funds all over the globe. In this case, they looked at the pension funds' performances in Europe and demonstrated that listed real estate has one of the lowest correlations to fixed income, less than private equity, and significantly less than unlisted real estate. And when you think about the pension funds asset allocation, mostly in bonds. This is a significant concept to think about. A lot of money is going into the real estate sector, and we firmly believe that a lot more can be coming into the listed real estate sector. Our research team did a white paper on inflation. Now, this was done towards the end of last year, so obviously there has been some changes, especially in the with the war, unfortunate war that's going on. But nevertheless, one at a very high level, listed real estate performs maybe not so good in absolute terms compared to recent history, which I think is to be expected, but in relative terms actually performs quite well. And one of the reasons why, on top of these key takeaways, which I'll briefly go into, is that the tenancy agreements of some of the companies have inflation-linked clauses in it. So, and then when you look at, for example, the logistics sector, there's still a lot of potential to increase rents. So a lot of that can be absorbed by tenants. Another key takeaway is that property yields and government spreads support income returns and property valuations. There's a strong and positive correlation between corporate profits and inflation inflation dynamics support companies' revenues and rental growth. If you are interested in this report, we'd be happy to send it to you. And the final slide I want to go through, which just really highlights the resilience of the listed real estate sector, is we commissioned a research report with Oxford Economics, which is a leading research house. And this was originally commissioned in May of 2020, so right smack in the middle of the lockdown. And what we wanted them to do was to see how long it would take for the developed Europe index series to recover to the pre-crisis peak. So the pre-crisis peak was given of the date of 19th of February 2020, and Oxford Economics forecasted that it would take between 20 to 26 months to get back to the pre-crisis peak. But the reality is that it took around 18 months. So at August 2021, the Developed Europe Index Series actually recovered, which is, I think, a testament to the resilience and the strength of the sectors, and in particular, some of the underlying sectors that performed very well, such as self-storage and industrial. And that is one of the takeaways, is that not all sectors performed equally. Some sectors have faced some headwinds, even pre-pandemic, some more brought on by the pandemic, such as the office sector. But net, the Developed Europe Index Series recovered in around 18 months. And finally, just want to mention about EPRA. So we are, as Wolfgang mentioned, the Public Real Estate Association. Our membership has around 285. Around 2/3 of that is property companies. But I think something important to mention is that we also have investors, academics, and consultants that are also part of our membership. And this is really important in the concept of having a global view, because we want to ensure that all stakeholders have a voice when we want to grow the sector. So that's why our membership is quite diversified in that sense. And with that, I'll hand the floor back to Wolfgang.
Thank you very much, Serkan. It was very interesting, especially with regard to, if I may, to the correlations. You talked about the fixed income correlations, and there was a question from the audience, which I like to hand to you, which is about the correlation of REITs to stock markets. You have an answer to that as well.
Through our research, we do see that real estate is naturally correlated to the stock market, because listed real estate is by nature a public vehicle. However, over the long term, there's actually more of a correlation to real estate, and that makes sense because listed real estate, even though short term will be correlated to stock market, the underlying is bricks and mortars. So we have some information we can provide on that if the participant would like.
Okay. I think for the time being that should be sufficient. Since I'd like to hand you another question, which is the question of today, regarding our new situation and challenging demand to ESG. What is, to your understanding, the situation within the REITs industry, especially when it comes down to the demands from the investor community?
Sure. So, at EPRA, because, we really promote transparency and comparability, we actually work very closely with the listed real estate companies, and we ask them to produce in their annual report certain sustainability KPIs. And the idea is that the companies, we provide a guideline to them on how they can calculate it. And then as an investor, I can go in and compare multiple companies without doing my own calculation or methodology. It's all kind of, there's a guideline to that we have on our website. So we really want to promote transparency and comparability. And I think the investor community, especially on specialist listed real estate investors such as yourselves, really like this and are pushing companies more and more to disclose this information within their annual reports. I would like to also say there was a study commissioned by NAREIT, which is our sister association in the US, and they looked at GRESB ratings, so GRESB being an independent assessment company, and they rate both listed real estate companies, but also private real estate funds. And consistently across the board, listed real estate companies performed better from ESG perspective than private real estate funds, which I thought was an interesting analysis.
Very good. Thank you very much, Serkan, for being with us today.
Thank you for having me.
With that, I like to go onwards, introducing you to our next speakers, where we are very happy to welcome Rainer Schmitt and Dr. Hilger von Livonius, both partners at the renowned law firm K&L Gates out of the Frankfurt and Munich office. And they will address the formal aspects of REITs, taking us through the legal, regulatory, and taxation issues that investors need to be aware of. Rainer, Hilger, it's your floor.
Yes, thank you very much, Wolfgang. Good morning, everybody. So we'd be speaking about REITs, and in particular on the existing DeA Capital REIT fund in Luxembourg, at least on a high level and a simplified assumption level. So we'll be talking first about the structure itself a little bit, then the regulatory and tax aspects. Here you see a simplified structure chart of the fund, so it's pretty easy to understand. You have in the middle the question solution fund, which in respect of the REIT compartment qualifies as an FCP UCITS fund. FCP is similar to what German investors are used to as Sondervermögen, and UCITS funds are funds investing into shares. whereby from a German perspective, we understand that the fund itself complies with the additional requirements of a German Spezialinvestment Fund. The fund itself is investing into REITs globally, at least in as far as they are domiciled in OECD countries. And for purposes of simplification, today we assume that these REITs are not German REITs, so no G-REITs for obvious reasons, and that none of the funds is investing into German real estate. So basically, the REITs will invest into property in their country of domiciliation or other countries on a more or less global scale. The investor basis, again, is global. And from the technical side, the AFM is Quaestio Capital Management. The advisor to the fund and providing the advice at the advisory board level is DeA Capital Real Estate in Germany in particular. The fund is regulated by CSSF, distribution catered for by AHK Capital Management. And those are the basic key factors of the fund. For purposes of this short presentation, we are working off a few simplified assumptions, which are that the REITs the fund is investment into are typical listed REITs, such as public corporate REITs, which are subject to investment supervision. And they are listed. So in distinction to the listed funds we've been talking to in the last presentation, these are listed at an EU EWR or equivalent third country stock exchange, but only a specific criteria applies. These REITs are tax-exempt REITs, hence they are not the typical private listed real estate companies, but exempt REITs, which upon distribution may withhold a withholding tax. The requirement is typical that about 75% more or less of the investment is made into real estate. One of the advantages for the investors is the intensive reporting requirements to investors due to the listing requirements or the requirements of the respective stock exchange. You may face typically a limitation of percentage in shareholding per REIT and the obligation that is very typical to distribute all or most of the profits on an annual basis. As for the fund, we already mentioned it's an FCP UCITS qualifying. That's our assumption as a Spezialinvestment Fund for German tax purposes, hence it's tax transparent. So let's move on to the selected regulatory aspects, and I forward to Hilger von Livonius.
Thank you, Rainer. Looking at the fund from a regulatory perspective, I would first like to briefly touch some issues concerning the regulation of the fund itself, and then also have a quick look at those requirements resulting from investor regulation. The latter one primarily from a German perspective for those investors, institutional investors, which we typically find here, like locally organized pension schemes, Versorgungswerke, and the like. So based on the understanding that the fund follows a strategy which replicates UCITS rules, one could raise the question how to classify the underlying investments, i.e. the REIT shares. The UCITS rules typically require a fund to make investments in instruments which can be considered as fungible securities that are admitted to or dealt on a so-called regulated market, it being understood that the term of the regulated market mirrors also the European understanding from the directives, and typically covers, as Rainer already pointed out, next to the EU or EEA markets, also equivalent third country markets. One thing that should be noted is since UCITS rules typically would only allow investment in other funds if they are considered to be UCITS funds, that may theoretically raise the question whether a REIT could itself be classified as a fund. And then it would typically, if so, not be a UCITS fund, of course, but rather an AIF. To draw this distinction, key criterion is typically whether the entity itself holds or pursues a more buy and hold strategy or acts as an active developer. While in the latter case, that would exclude assumption of a fund, of an AIF. But we think in the end, REITs should typically meet the requirements for transferable securities in terms of the UCITS rules anyway. And that should, in our view, overrule a potential reclassification into an AIF. So on that basis, assuming that the REIT has a typical corporate form type and its shares are fully listed on a regulated market, that should meet the UCITS requirements and therefore qualify as an eligible investment. If we could move on to the next slide, then we have also taken a look at requirements for German pension investors, in particular those which are subject to the German Anlageverordnung. For these purposes, the key question will probably for many investors be, can the indirect exposure to the REITs be allocated to the so-called real estate quota? You may be aware that the investors under the Anlageverordnung have certain quotas to which they can attribute their investments. And so there is this real estate quota, which makes up 25% of the entire so-called security asset Sicherungsvermögen. Within this 25% real estate quota, you would typically be able to allocate any direct or indirect REIT exposure. We have, and we will on the next slide take a closer look, but what needs to be fulfilled. But the idea would be that the investor would hold the investment in the REITs fund by allocation to the real estate quota, and that in accordance with regulatory practice established by our regulator BaFin, would require a so-called REITs test to be passed. That test requiring that certain criteria are met at the REIT level, which include, and that's very similar to what Rainer had already explained on an earlier slide, that in particular, at least 75% of the assets of the REIT need to be invested in real estate. The second criterion would be that also at least 75% of the gross revenues of the REIT have to be generated from letting and leasing of that real estate assets. Third criterion is that at least 90% of the profits of the entity need to be distributed on a regular and ongoing basis. So it is not possible to retain larger amounts of the profits. Fourth criterion is that in terms of leverage, loans may be taken up to 70% of the value of the assets, or in other words, the equity part of the REIT must make up at least 30% of the value of the movable properties held. And the final thing is a more formal one that, of course, depending on the chosen legal form of the REIT, the statutory capital must be fully paid up. So assuming that all these criteria are met, a German investor would typically in a position to hold that investment in the REIT fund as part of its real estate quota. That's it, I think, from my side. Rainer, do you want to follow up with some further tax aspects?
Yes, please. Thanks very much. Let's go to a snapshot of selected tax aspects, again, from a kind of helicopter perspective. Perhaps to start at the level of the investee companies, the REITs. The REITs, as we mentioned before, are typically tax exempt in their various countries of domiciliation, i.e., those REITs we are talking about, there are others, of course, but those REITs we are talking about do not pay taxes on their property income, be it the current income or the capital gains from the alienation of property in their country of residence. Of course, to the extent those REITs are investing into properties in other countries, such other countries may levy tax on the real estate income derived or achieved. Where there applies a tax is upon distribution of the REITs. We said that the REITs will distribute most of their income on an annual basis generated in the respective previous business year. And those distributions are subject to withholding tax. The withholding tax rate, of course, is a determining factor in the various countries of the funds. So there is no general percentage I can give you on that one. So basically what we can take from that is that the REIT's income very roughly is subject only to the withholding tax upon distribution to the shareholder, where the shareholder currently in our case is the fund investing in the REITs. And the fund in Luxembourg, as it is an FCP, is tax exempt if we ignore the very, very small taxe d'amendement levied in Luxembourg, but no corporate income tax or so. Again, as it is an FCP, no withholding tax is levied on the distribution of the Luxembourg fund. And also good news, the fund itself is also not taxable as it qualifies as a Spezial investment fund and has opted to tax transparency for purposes of the German tax regime. Our assumption, just to remind you, was that there is no German-sourced income, so I don't need to speak about that. Let's come to the top level, which are the German investors. The investors can be different types of investors being subject to tax or tax-exempt investors, just for their generic qualification of the investment. Any REITs investment itself does not qualify as an investment fund for German tax purposes, but we would start to look down the chain of investments. So, of course, the Equestio Solutions Fund qualifies as an investment fund, but on a look-through basis, its investee companies, the REITs, would not qualify as a REIT. As an investment fund. But technically, the REITs would qualify as a investment in shares of companies with the specific qualification under the Investment Tax Act as a so-called Immobiliengesellschaft. The income is qualified as investment income and hence subject to the regime the investor is subject to is either taxed or not. Where the investor is tax exempt in Germany, you will not see any taxation in Germany. Again, we have assumed no German sourced income, so the 3/5 German withholding tax rate does not apply. I just have inserted here as a reminder where there would be German sourced income. So for the tax-exempt investor, the only tax on the investment would typically be the withholding tax withheld by the REIT upon its distribution to the fund. When we come to the taxable investors, they are, and I'm now speaking about unlimited investors being subject to unlimited tax liability in Germany. They are taxed on the distributions, Ausschüttung, deemed distributions, Ausschüttungsgleichen Erträge, and or the capital gains from the sale of shares in the fund. The main German exemption from taxes in this corporate area, so Section 8b, does not apply. If it were to apply, any dividends were tax exempt in Germany and the capital gains were exempt, the dividends upon the condition that the shareholder on a look-through basis holds 15% in the underlying REIT. There is one exemption where that applies, but it is only the case where the REIT itself would be subject to corporate income taxes or a similar tax of 15% or more. However, our working assumption for this fund structure was that REITs are tax exempt. So the exemption in Germany itself would not be applicable. There may be, on a case-by-case basis, an exemption being applicable under respective double tax treaties, where the investor qualifies as an entitled person and holds the relevant shareholding. That very much depends on the definition of whether the REIT or the qualification only applies to taxable target companies or not, and how the REITs are treated. So the taxable investor faces the fact that the distribution or deemed distribution is subject to tax in Germany. However, and I will not go into detail, the withholding tax levied at the level of the REIT may be creditable to the German investor against its tax bill in Germany. There is one question which has been raised recently, which is whether or not the REITs or the REITs income itself is subject to the so-called Hinzurechnungsbesteuerung, CFC rules in Germany. You may recall that up until shortly, any income derived through investment funds, here Quaestio, would not be subject to the CFC rules in Germany. It would simply be sheltered. That has changed now under the new law applicable as of 2022. However, in practice, the CFC rules would require that the fund is dominating its investment into a REIT and has a respective shareholding or say in the REIT. This is very, very unlikely here, even if we take into consideration that the domination does not need to be on an investor level, but can be on the level of the Quaestio Solution Fund or any corporation of investors into the REIT. Hence, this domination is rather unlikely, as I said it, and thereby the applicability of the CFC rules is as well. Even if it were applicable, one would have to do the active income test, i.e. to look at the double tax treaty between the country where the real estate is domiciled and the investor itself. So there may be another safe harbor as well. That concludes the comments on the regulatory and tax aspects of the REITs from an helicopter perspective. And I hereby would like to hand over back to Wolfgang. Thank you very much.
Thank you very much, Rainer and Hilger. This was kind of an interesting, even though short, but interesting insight. And usually those legal and tax presentations are maybe a little bit heavy for those who are not familiar with the subject. but you've done it in a very lively way. So I think everybody enjoyed the presentation, though. We've received some questions, and in the interest of time, let me focus maybe on two of them only. First question, and maybe goes to you, Rainer. The question is about the requirement of the listing of the REITs under the UCITS regime. And the question was, does it exclude US REITs? I think the question goes more to the private REITs existing in under the US regime. But what's your answer to that?
Yeah, well, I'm happy to answer that question. I probably should defer to the real specialist, which is Hilger in this case.
Thank you, Rainer. Of course, it is a good and very important question, I think. As Rainer had already pointed out, we have, or we also allow third country stock exchanges for these purposes, assuming we have some kind of equivalence. For these purposes, the regulators regularly make their assessments, and I can speak, for example, for BaFin, which regularly issues a list of admitted stock exchanges, and they also include major US exchanges, of course, also the Canadian ones, which might also be of relevance to the REITs you would be looking at. But for example, also some marketplaces in China, in Japan, of course, and not to forget, since they have left the EU, also in the UK. So all larger exchanges and markets are considered to be equivalent. The equivalent test would typically have a focus on aspects like, is the market open to the public? Is it somewhat, is trading appearing in accordance with certain rules? And is there a certain kind of supervision of the trading and of the market itself?
Perfect. Next question is going to the application of Solvency I. Do you also have a view on the treatment of the fund under Solvency II?
Well, yeah, indeed. I had only focused earlier on Solvency I. For Solvency II purposes, I think the analysis is, of course, slightly different, since Solvency II is much less formalized than our Solvency I rules, where we have these investment buckets, which require the fulfillment of certain rather formal criteria. For Solvency II, I would think, of course, we have the real estate class there with the shock factor of 25% only, versus something which obviously could be seen in connection with REITs is the listed equity with a 39% shock factor, apparently much higher than the 25%, although I think you would typically have to apply the 39% on a net asset value basis, while the 25 would apply on a gross asset value basis, which, depending, of course, on the relevant REIT, could make a difference. Quite recently, the European Union had already also introduced a new sub-factor within the shock factor for equity investments, and that's a 22% factor applying to the long-term investment, which I think could be applied in certain circumstances, provided that the relevant requirements of the delegated regulation, I think it's Article 171 or so, have to be met. Particularly, I think the 5-year holding term. There are various ways to classify the investment. I would take the ideal solution would, of course, be the 2% applying to long term. Otherwise, also the 39% would be applicable. The 25% for real estate would, in my view, require an enhanced transparency of the underlying assets, and that might, in some cases, be difficult to achieve.
Yeah, but that's good news. The takeaway seems to be the underlying equity is lower compared to real estate, which makes the REITs investment even more interesting, as long as this is building part of the real estate portfolio. Thank you very much, Rainer and Hilger, for your presentation and the formal insights on the REITs, which leaves us to go forward to the operational characteristics of REITs. And here we're happy to welcome Thomas Körfgen. Thomas used to be the managing director at SEB Asset Management, recently known as Savills Investment Management, leading the listed real estate department, focusing on REITs investments in particular. And we are very happy having Thomas on board as our senior advisor, providing us with this long-standing track record and experience in the REITs market. And Thomas, from his perspective of operational experience, will give us an overview on the features and advantages of REITs from an operational perspective. Thomas.
Yeah, thank you very much, Wolfgang, and good morning to everyone. So let me give you the overview why REITs as the liquid form of core real estate are the cheapest, the fastest, and I think the most efficient products to invest into real estate. So there are many reasons, and you see them on this slide. REITs are the most liquid and flexible allocation to real estate. And I will describe on the next slides why we think it's the case. REITs, they offer higher dividends than other liquid assets, and also in comparison to real estate products, it is much more you can receive as ordinary income. As we just heard, REITs are tax transparent. They provide a wide diversification, not only sector, but also country-wise. We heard a little bit from Serkan about the long-term volatility of REITs and also the short-term, but overall, the volatility of REITs is low. And last but not least, and this is more a result of the 5 points, there is a high correlation to the direct real estate market because we are talking about the same underlying properties. So let me start with the high liquidity of REITs. With REITs, you can trade the real estate market on a daily basis. You can trade individual sectors, countries, you can trade themes like data storage, you can trade all those properties where you don't find direct exposure you like to be invested in. Either it takes long time or you don't find anyone who is going to sell at a reasonable price. So you can invest on a daily basis into those properties you want to be invested. So this means REITs are not only a really good or maybe the best instrument for strategical asset management and asset allocation, but also for the tactical one. And the positive side effects are you have on the one hand really low transaction costs. You don't have any due diligence efforts. You have an easy market access, and you just need a low minimum investment to be invested. One share of a REIT is the minimum investment. So having said that, the second point is you have not only stable, you also have high dividends. And those dividend payments are predictable because, as we heard, REITs have to pay out most of their profits as dividend. So you can rely on the regular cash flow you need. Due to the efficient company structure of REITs, also in comparison to many of the real estate funds, the payout ratio is usually higher or at least comparable with other real estate structures. Tax transparency, let me skip this slide. We heard it much better than just in one slide. Let's go to diversification impact. As I mentioned, REITs allow a broad diversification on a sector, but also regional diversification independently of the volume which can be invested. So you can access, and this is a little bit different to what Serkan said, because Serkan had as base the EPRA and REIT indices. Not all of the REITs are in those indices. So you can get access to nearly 1,000 REIT companies across 40 countries. And you can get exposure in 15 different sectors with a market cap of around $3 trillion. And this is really diversification. But also when you invest in just a few REITs or when you invest in a global REIT fund, you have much more diversification than investing in just one fund. So coming to volatility, and this is, I think, the most important slide, because talking about REITs or REIT portfolios, normally we will be asked about volatility. And to be honest, volatility always is seen as negative. But the truth is, volatility of REITs is not higher than volatility of direct real estate on a longer term. Furthermore, REITs, they provide better risk-adjusted returns than any style of private real estate. And there might be some short-term volatility of REITs, which could be higher than longer-term volatility. But and this is also a chance and not only a risk, because what does volatility mean? It does not mean that stock prices, or in this case, REIT prices, are falling and REIT prices do suffer. No, the opposite might be the case. An increase in short-term volatility could also mean that REIT prices go up. And so in this case, as a positive sub-effect and impact, you can trade REITs for additional income, which is not possible when you buy and hold a property for a decade or even longer. So overall, on a long-term base, volatility always reverses to the mean. So volatility is not only a risk. It is, when you are expert in investing into REITs, it's a chance to get more income. So last but not least, and this is a result of the advantages and features of REITs I mentioned, there is a very high correlation between listed real estate and REITs with the direct property market over the long term. And both investment classes invest basically in the same underlying assets. And REITs always have to reflect the performance of the underlying real estate. Let me give you an example. When you have a really huge building and you have it in a fund, in a real estate fund, everybody says, well, this is the asset class of real estate. Yes, it is. Now you take this property and put it onto the stock market as a REIT. Many people say, no, it's equity. Does it make sense? For me, not. Or let me try to change this example a little bit. When you take half of the building and put half of the building on the stock market and you let half of the building in your fund, in your real estate fund, does it mean that half of the building is real estate and half of the building is equity? No, this really does not make any sense. But REITs combine more features that are particularly relevant in the current era. You have financial advantages of real estate, of REITs, because REITs have those financing advantages because they do have direct capital market access. And with this possibility, with these options, REITs don't need to finance each property by itself. They don't need to finance property by property. And the complex process of financing the commercial property by evaluating the long-term lettability of the property, the current tenants and tenancy agreements, and many of other property-related key figures, you don't need with the REIT because the REIT can refinance itself on the capital market by issuing subordinated secured bonds or even by raising equity. So what does this mean? Due to the broad diversification of the REIT and the credit assessment by the capital markets and external rating, the risk premium of a capital markets loan is often lower than of an individual property acquired by a fund. So in other words, this means a REIT or a real estate portfolio holder can offer a higher price for a property through its lower financing costs with the same economic profitability as a comparable fund. You also have, as a really huge advantage, a time aspect. Because once the debt financing has been made via the capital market, the money can be used immediately and at any time. And when the decision is made to grant an individual loan for a new property to be acquired, a new lending process starts each time as part of the due diligence of the property acquisition. And not that this is time consuming enough. The fund manager is also committed to the best practice approach. Each time to find several banks have to be approached in order to accept the most favorable offer for the fund. And this means REITs don't have the problem like funds getting money and need to find properties, not to be diluted. REITs can look for good and profitable properties. Afterwards, the money which is available can be used. And let me come to my last point, that REITs perform well during interest upcycles and inflationary environment. So they not only can perform, normally they really outperform and they have a positive performance. And in fact, this is supported by empirical evidence. In the last nearly 50 years since the first major US REIT index was published, there were about 25 years of interest rate increases. And the US REITs had a positive performance in 20 or even more of them. And this means due to an economic expansion, rents are increasing alongside interest rates. And thus, as long as income increases as fast enough, also capital value can continue to go up. So this is a short overview about some of the advantages. There are many more, but because of the time, thank you very much for listening. And if there are any questions, I'm happy to answer.
Thank you very much, Thomas. I think you covered the most important points. In the interest of time, I would hand you just one of the questions which have been received here, which is on your aspect in your presentation regarding the financing advantages of REITs. Could you give us an indication about the financial advantage in basis points?
Well, it depends on the interest rate environment. And when we had interest rates of approximately 1% for properties, companies like Unibail or Alstria were able to get loans below 50 basis points. And now you can also see this difference might be much higher now because the REITs have got the money in the past when interest rates were lower. And in comparison to finance property by property now, this difference between what funds have to pay and what REITs or also real estate companies have to pay is even higher.
Okay. Thank you very much, Thomas. I'll think we'll move forward. Next topic, we would allow us to give you a little bit of insight to our product, which is reflecting all those benefits we just learned about. I'm very happy to be able to tell you that we've received this week confirmation by the CSSF on the marketing for this fund. So it's up and soon running. And let me give you some of the key metrics of the fund. And obviously, in the interest of time, allow me that, following the presentation, you will receive our full presentation set, so that I focus on the REITs fund criteria only. We heard about the outperformance of REITs compared to other asset classes. I think that's mainly true on the long term, and that's how we thought about this product. We thought that having learned about the benefits of the REITs, that we indeed have a product which is much more real estate than equities. And on this slide, you see the comparison of listed REITs to listed real estate and real estate funds. And kind of interesting is obviously liquidity is very high in the listed sector, whereas to the fund sector only limited. Same goes for cost efficiency in terms of management fees and associated costs, especially thinking about transaction costs for real estate due diligence, etc., does not exist in this field. We've learned about diversification. As you can see, yes, there are diversified funds in the product universe. However, limited diversification compared, at least, to REITs. Volatility, as Thomas already pointed out, and Serkan was alluding to as well, there is a short-term volatility, whereas long-term it's balancing out. And I will come to that in a minute with a specific example. Correlation very much to real estate, very high, lesser so to fixed income and other equities. Tax transparency fully given. That's not the case with listed real estate, and that's very much and very often a misunderstanding that REITs are seen as listed real estate, which is true, but in terms of tax transparency, it's a totally different type of animal, where we have the tax transparency, as Rainer was already outlining, versus listed real estate, where you don't have that benefit. Stable dividends due to the dividend payment obligation, real estate quota qualification, as well as the benefits on Solvency II, as Hilger was alluding to already. The management fee level, as I already mentioned, is quite low. And one of the points which we have not touched upon yet very much is the time to market situation, where under the REITs, and that obviously goes for all of the listed real estate sector, is very liquid, and therefore investing into especially niche sectors where product availability is limited, that's not the case in that sector. And immediately, and I'd like to say on an ongoing basis, give me your mandate in 24 hours, you be fully invested. And that's obviously not the case in the fund sector. So the whole fund is designed to meet the expectations of investors, meaning who are used to invest in real estate funds. The REIT fund has the same features, especially in terms of focusing on cash returns, which we do expect above 5%. It's qualified for the real estate quota, since we're focusing on OECD domiciled REITs only, and the solvency benefit we talked about is applicable at the same time. Furthermore, and that's today a requirement, I think, without any discussion, the fund is qualified according to Article 8 of the SFDR, and therefore plays its role in the real estate portfolio likewise. So let me go to the key metrics. As you can see here, one of the questions I always get is the question, and maybe we will come to that in a minute again. But the question we get is, what's about leverage? Are you going to leverage the portfolio? And the answer is no. Leverage is provided under the REITs portfolios themselves, and on fund level, there's no intention to put further leverage on. Rather, we like to focus on the portfolio level of the REITs and on the overall level of all portfolios that the leverage is below 50%, so that we meet the requirements typical fund investors would have in this respect as well. Now, let me shortly give my colleague Thorsten the opportunity to give a short but deep insight into our selection model and process to come up with our model portfolio that's subject to the fund. Thorsten is a director in our team and responsible for this fund. So I like to leave the floor to Thomas, and he will give you a little bit more of that insight.
Thank you, Wolfgang. Yes, because we are running out of time, we have a strict investment process that is subject to various criteria, and the clear focus is what also Thomas mentioned, is the long-term sustainable dividend payments. And what Wolfgang mentioned, we are also looking for ESG and SDG criteria. What does our current model portfolio, which will be the starting portfolio for the fund, looks like at the moment? We have selected 36 companies globally, which fulfill our criteria, which I will explain a little bit later. The portfolio of this fund has a loan-to-value of 33%, an interest cover ratio of 5.2, and a price to net asset value of 1.1. Concerning the composition, we only have 3 companies which will have a weight over 5% within the portfolio. Currently, we are overweight in logistics, data warehouse, and healthcare. And within, because we heard the problems in Europe, within our top holdings, there are non-European names as of today. That could change. It has a little bit to do not only with war in Ukraine, but also because most of the bigger European names are retail. And at the current stage, we are a little bit cautious of a further development of retail. How does our investment and risk management process look like? We have built up that 3-stage investment process, which, as I said, is intended to guarantee the achievement of sustainable dividend income, and had proved that in the past. In addition, very important topic is ESG and SDG. We are convinced that that will be an integral part of the future financial reporting. As it's now usual to use credit ratings for bonds, it will be also a normal part for listed real estate and REITs to have an ESG or SDG rating. Our starting point is an investment universe of 900 companies, which is analyzed on a quantitative base. Some of these criteria are mentioned before. It's interest cover ratio, loan to value, but also dividend yield and the valuation. These data we collect for these companies go into our database, which are updated on a regular basis with the financial and real estate figures. After applying these criteria, we end up in the second stage with 165 companies. These 165 companies then will be analyzed on a qualitative base. Means that we are talking to the management on a regular basis, looking at the management track record, the strategy of a company, and if there are shareholder value approaches. One of our main criteria to invest into a company is that we have to meet the management of a company before. So we will not invest in, for us, unknown companies. After applying the quantitative and qualitative analysis, we currently have a target cluster of 50 companies. This is the third stage. In these 50 companies, we look for our internal economic outlook, so which regions are more preferable, which sectors are more preferable. And of course, we are looking through the underlying portfolio of these companies. After doing that, we come our target portfolio. I mentioned before, the current 36 companies we have selected have or cover 10 sectors. 44% of the portfolio is in logistic and data centers, as we think at the current stage, it's the most defensive sectors. Only 20% of our portfolio roughly is in retail. As I mentioned before, we are a little bit cautious on that sector, but as Thomas said in his slide, there will be opportunities within the next months. We have exposure to over 50 countries. Main exposure currently is North America, Australia, and France. And the underlying property value we cover with these 36 names are over 350 billion euros. I want to come to the end with the most interesting part for you. What can you expect for the next 12 months? We are quite sure that we will achieve a minimum dividend yield of 4.7% or even higher. In comparison, the global REIT benchmark currently offers only 3%. Overall, we expect a total return for 2022 of 11 to 40% for the fund, whereof, as I mentioned before, around about 4 to 5% income return cash on cash. So thank you very much, and I'm happy to answer your questions.
Yes, thank you very much, Thorsten. I think we're really running out of time, so allow me to answer the questions after the webinar, Thorsten. Thank you very much. And I think we've come to the end of our webinar today, and I'd like to take the opportunity to thank everybody, especially from the audience, to attending today's event, especially engaging. We've received a number of questions, and obviously we were not able to answer all of them, but we'll revert back to you and provide proper answers to it. And finally, I really like to say a big thank you to all of our panelists today, especially to Serkan Erol from EPRA, Thomas Körfgen, our senior advisor, Dr. von Livonius and Rainer Schmitt of KNL Gates, Franca Pileri from Questio Capital, Martina Muehlhofer from CBRE, Dr. Schilling from DeA Capital, last but not least, Paolo Scordino, our colleague from DeA Capital Real Estate SGR. Thank you very much for having contributed to our event today. I'm sure the participants have appreciated the information you provided us with. And another special thanks before we close the webinar for today goes to my young colleague, Alessandro Solazzo, for the language interpretation to our Italian attendees. Thank you very much, Alessandro, for giving us that service, so to say. We look forward to welcoming you again to future events of DeA Capital. Hope you enjoyed today's webinar. Until then, have a good day, nice weekend, sunny weather. See you next time. Bye-bye.